In this video, traders, we're going to look at where to set your stop loss so it doesn't get hit. Stay tuned. Hey traders, a very warm welcome to you. If you're new here, hello, and if you're not and you're a subscriber and you are a veteran, welcome back. Okay, so where do we set our stop loss so it doesn't get hit? Okay, we could say 10,000 points away. There you go, there's the answer, end of video. That's not going to get hit. Now, what's the point in that? The idea of a stop loss is that it's far enough away that it doesn't get hit, but it's not too far away that we just got a ridiculous risk reward. Anyone can have the answer to this and just say, hey, put it at the 10-year low and you're not going to get hit in the next 5 days. Pretty much that's not going to happen, right? But then what's the point? There's no point in that. We're all about making as much money as possible for as least little risk as possible. That's what we're trying to do as traders. So we've got to allow for noise and we've got to have it as close as possible. The best stop loss is the one that gets missed by a tick every single time. Never going to happen, but how close can we get to it? Okay, so couple of things we need to look at when we're looking at stop losses. First of all, let's just cut this, or let's delve into this myth of stop hunting. Now, you know, we as retail traders often hear, hey, the brokers are looking for our stops and this, that, the other. And in a way, it's correct. In a way, it's not. Let me explain my take on this, rightly or wrongly, in the comments in the comment section below. Many people will put their stop loss in exactly the same position. Now, the market knows this. There isn't a conglomerate of people who are combining and making concerted effort to move the market in one direction. I say that with caution because if you go back and you listen to pit audio, then the locals would do exactly that. And they would move the market to where they knew there were stop losses to find liquidity. However, naturally the market will move to pools of liquidity. If there are stop losses above highs, market is naturally going to move to that high if it has the supply demand imbalance and find those stop losses. When it finds that pool of liquidity, it will change the dynamic of the market and reverse. And it looks, for all intents and purposes, like you've been stop hunting because you'll have your stop in a place where everyone else has got it, the market's moved to it, that has hit it, that's all of a sudden, that's the last batch of buying coming in at the highs for your short, you're out, it turns because that's the end of the buyers. So it's kind of a self-fulfilling prophecy in a way. But anyway, getting that out of the way for now, let's have a look and think about strategies and ideas for placing our stops. The main thing is we don't want to be putting it where everyone else is if we can. That's really the main thing. But the few things we need to look at are, what's the volatility of the market? If the volatility is very, very high, you are going to have a wide stop because this could be considered a noise factor, if you like. I mean, not necessarily have to use the correct term, volatility. How much noise in the market? In other words, you know, if this thing is swinging 100 pips every couple of minutes, you put a 20 pip stop in, you're going to get pinged because it's just noise. It's literally just, you know, someone swinging a tiny bit of size around, the order book is thin, you're going to get stopped out. You need to say, hey, listen, this is 100 pips in a few minutes. I need to at least be way behind this. So that's the first thing. And vice versa, you know, if the market is very, very slow, I've traded through some very slow markets, we're plodding along, you know, 2 or 3 pips a minute or something, if that. You know, I've seen candles on the Dow, we've had 1 tick a minute, for example. So there's no point then using 100 tick stop, 100 pip stop, whatever your market you're trading, unnecessary. You know, your probably target is going to be 25 max. You've got 100, doesn't make any sense. The trade will be completely negated. So you've got to look at the volatility of the market and look at the volatility conditions and how much range there is in each of the candles and the time frame you're trading. That's the first big thing. First mistake that, you know, I see a lot of people making, and myself included. Sometimes you misjudge the volatility, you pinged out, you're like, well, that was pretty stupid. Look at the state of the market. You know, that is way too tight. That stop is always going to get pinged. And if it didn't, it's pure luck. And eventually it will get pinged if you carry on with that kind of magnitude of stop. All right, so you look at that one. Next thing is, where does the market want to go? This is a bit, you're probably thinking, well, surely that's what we're trying to figure out as traders. Yes and no, right? Most of the time we have a general idea where the market's going to go, but the trick of being a good trader is to, like I say, maximize that profit and minimize that risk. There's no point in us saying, hey, the market's going up, you know, 50 ticks. If it goes against us 500 first, we may be right, but we've stacked with a drawdown of 500. That's no good for anybody. So really, you've got to kind of use your intuition and use your analysis and say, hey, we're in an uptrend. The market feels like it wants to go higher. You know, I want to get long, I'm getting long on this pullback or this double bottom after consolidation, whatever. We're bullish. I think it wants to go higher. This is my intention. So how extreme is that? Are we in a really tight trend day, in which case I can probably bring my stop up and not worry about it too much? Are we kind of counter trend in a reasonably big trend, and we've still got a maybe potentially a little bit of downside to go before we turn, in which case I might have to bring a bit of a wider stop because I'm trying to catch this extreme level and pop, but we could have a little bit more downside before we swing, as opposed to an uptrend which might just pause a little bit. You're not going to have that as far away. So it's kind of where the market wants to go in the short term, and allowing for that and saying, hey, and being objective as well. It's all very well saying, no, this is the perfect entry. In reality, it's never going to be. You need to look at the conditions and say, well, actually, yeah, we might have 2 or 3 more days of selling if we're swing trading. Let me allow for that, put my stop under what I believe could be 2 or 3 days of selling, and adjust my position size to suit. And then hopefully I'm going to get on the trend, and it's going to give me that multi-week move that I'm looking for. Next one is prior probe magnitudes. What I mean by this, I mean that, you know, when you're looking at maybe a key level or something you're working off, how often has the market kind of gone through it, done some work below it? You know, have we had any wicks that have gone through it, any pin bars? You know, how has it generally handled key levels that you're trading off before? Because current market conditions, you know, back testing is great and all that, but I'm a big fan of eyeballing what is happening now. And for me, if I'm day trading, that's going to be in the last 5 days. If you're swing trading, it's going to be in the last month, whatever it may be. What has happened then? If it's penetrated key levels and lows and it's been very wicked, often you can see the difference in charts, guys. You can see, hey, this thing is always flicking through highs and it's reversing and it's catching people out, it's doing fake outs. Or another chart might be very clean, it never goes through, or it goes through a very small amount. Just look at that and say, hey, the conditions at the moment are we are getting pretty decent probes through. I need to allow for that. What's the biggest probe? Let me place my stop behind it. Or we're hardly getting any probes through. I can tighten it right up and adjust my position size to suit. It's all about adjusting to the conditions. And then finally, kind of a good follow-on really from this is the environment. So what environment you're in? You know, what's driving the market? Is news coming out causing something to swing out? You know, are we getting, you know, massive bursts of volume? Are we getting big down days, big up days? You know, what is the general environment? This is really the key to stop placement. It's not about where you want to put your stop. I mean, everyone wants to put their stop tight. Everyone wants to do that because they can increase their position size. They feel like a genius. The risk reward goes up. And we talked about strategies for doing that. But ultimately, you've still got to be objective and say, hey, this thing is swinging around. It could go against me quite a bit before it turns. I'm either going to have a scaling strategy or I'm going to have to use a bit of a wide stop and allow for that noise, allow for that mistimed entry so I don't get pinged. Or you say to yourself, listen, everyone else is going to have their stop under that low. Everyone is. So why don't I either take the trade where I am and double my stop, halve my position size, or put my entry where the people have the stop and then have my stop even further. The point of the stop is you want it in a place where the trade is negated. In other words, it's done, the thesis is wrong, you know, it's not going to work out. So the further away from that, the more likely that is correct, if that makes sense. In other words, if it's pinged, you don't want it pinged and it coming back. And it's like, well, I thought it'd be negated because it went through the low. Well, no, because actually just a fake out. Where would it have to be? Probably 3 or 4 closes below that low for the counter trend trade to be negated, or the pullback trade to be negated. So you've got to adjust for noise, always being a lookout on the volatility of the market you're trading. You can get caught out from trading different types of markets. Where does the market want to go? Objectively looking at it. Hey, well, I'm buying a pullback. I might be a bit early here, but I'm prepared to be early because I want to be on board this. However, the sacrifice I must make is a wider stop, or I wait and I potentially miss out on it, and I have to chase it if I want to do that. Prior probe magnitudes. How often has it kind of gone against it and pinged back? Key levels. Has it stuck to key levels or not? An environment. Kind of the whole broad thing of looking at the whole big picture. What's the 5 minute if you're trading on 5? What's the hourly? What's the daily? What's the 4 hourly? Where are we in a range? You know, what's driving it? All this kind of stuff helps you use your stop. But if in doubt, keep it wide, keep the position size down. You can always make notes and say, hey, you know what? I've been using a 50 pip stop, and my maximum adverse excursion on the trade in all of the 100 trades I've looked at has been 35. Of the ones that have gone in my direction. Obviously we stopped with a few, but the ones that have gone in my direction, so I can afford to be a little bit tighter. It's better doing that than having it tight and getting stopped out, frustrated and having to extend it. It's a better way of doing it wide and coming in. All right, guys, where to set your stop loss so it doesn't get hit. Thumbs up if you like this kind of stuff. See you next one. Take care. Goodbye.